Hey guys, good morning. Thank you very much for today's presentation, Mark and team. Intriguing update. I wanted to ask actually about Reko Diq and the CapEx update. So you've increased the CapEx, but actually quite modestly. So from 5 to 5.5 to 5.5 to 6 for phase one. Could you just walk us through what were the key elements driving that $500 million increase, particularly between cost inflation and then scope change?
Yeah, okay. So look, there's a few things there. The original price that was, thanks. The original price that was put in on the $5 billion was taken from a inflation adjustment from the 2010 feasibility study. So, that was how that number was derived. The 5.5 to 6 is actually derived by the tenders and all of the price inquiries to the market. So, as you can appreciate, there's therefore a lot of movement between the individual lines. But if you look at the entire thing, there's probably a few main drivers. The inclusion and finalisation of the solar and the power was one of the key items, particularly when you tie it back to the 45 million tonnes per annum, because we locked in that higher throughput. So there was a cost differential that was driven by that higher throughput and its associated requirements. And then there's also, a CPI, inflation component that does occur between that update you received in 2023 through to an update which is basically derived on pricing that we've received in the past 6 months. So it's an end of 2024 price. So there's a 5 to 10% movement in CPI in that period as well, and they're probably the main drivers.
And then similar question for the significant reduction in the C1 cash cost estimate for the project. Was that mostly driven by the gold price assumption, or is there some benefit to OpEx from the higher CapEx scope?
Yeah, it's both of them. So you get a benefit of the high throughput, so your unit costs do get a benefit from that side of it as well. But yeah, as you're noting, they're the main drivers. What you said.
Lawson, just to remember, this is just at the cusp of feasibility study, and it's a bankable feasibility study. So when the project comes out, you'll see everything's provided for, only reserves, and it's quite a different project than originally envisaged. We've gone with the IFC. You can imagine big focus on renewable energy, so bringing in the solar, and also it includes a railway upgrade down to the port, which wasn't contemplated initially. There was an assumption that the road down to the Gwadar port would have been constructed by Pakistan and the ongoing Belt and Road project. So there's a lot, and today, when you look at the logistics and the rail support, significantly more reliable. And we can see ourselves managing both the consumables and also the export of the concentrate down to Kasim, which the team shared with you. So quite a different scope, and a 5 million tonne for each phase increase in the throughput as well. So that's significant. So when you look at the NAV of the asset, it's been enhanced, and we put a lot more infrastructure into the mine that'll carry phase two as well. So you need to look at the total number when you look at the number.
And Mark, maybe if I could just quickly reinforce on that, because we've got this lending party with the IFC, their technical teams, their technical consultants, they've got a security consultant and an environmental social consultant. They're engaged with us through this whole process. So they're reviewing our work and testing these assumptions as well. So there's that additional check, I think, on Reko Diq and the process because of the funding that's going on concurrently.
Thanks. No? Daniel McConvey, Rossport Investments. On Reko Diq, remind me, how have your partners kind of made you more comfortable through this process? And in terms of the contractor selection,
Say that again?
how your partners, the government and your joint venture partner, your lenders, how have they kept you more comfortable through this process to date? And I'm wondering, in terms of the contractor selection you're making, I guess, at the end of this year, pretty soon, what you're looking at in terms of criteria for the strongest contractor to build it.
Say it again. Why don't you just repeat your question?
Sorry, we just couldn't hear the question about the partners.
Okay. How have your partners made you more comfortable in the process of going ahead? We talked about this a bit a couple of years ago. And then second, I was going to ask you about the contractor selection.
You're talking about the internal partners of government. Yeah, so the project is, as you know, is a negotiated project on the back of an arbitration award. And the whole concept was that we needed to negotiate a settlement, which what we did was reach out to the then Prime Minister, Imran Khan, and say, how are we going to deliver something that's going to benefit everyone? And because there's significant tax incentives and other incentives baked into the framework where we can see the value. And at that point, we felt that this is a new way of building mines. And as you know, we've done a number of them now. Tanzania is one example. Pueblo Viejo is another one, and so is Papua New Guinea. And so we said, well, let's split the equity. And the equity, and more importantly, Balochistan gets 25%, because that was one of the big issues back in 2013, is what was Pakistan Inc. going to benefit from. So then it was the 10% is a free carried under the mining code. So we pick up 5% so as 50% shareholders, we pick up 5%, and as 40% shareholders, the rest of Pakistan picks up 5%. And then the debate was who's going to actually carry the investment on behalf of Pakistan. And so the Pakistan government allocated the ownership of the equity to 3 SOEs, who are all oil and gas companies and have strong US dollar balance sheets. And so with that, there was the 15% outstanding that was still Balochistan, and the Pakistan government guaranteed that 15%. And then it was a case of funding. And we've been co-funding this since the beginning. So right now, the lending syndicate has been through the process of ensuring that they are comfortable with the guarantees that sit with the Pakistan Inc. part of the equity. And we have an arrangement that is now secured, and the lenders are comfortable with the source of funds out of Pakistan. The engagement we've had with and I would just point out that the team that negotiated with us from the time we reached out to say, let's find a win-win situation, stayed even when the government changed. So as we we signed the framework agreement with Imran Khan, and we signed the final agreements with Shahbaz Sharif. Then what we did is we took, because remember the whole issue revolved around a Supreme Court decision back in 2013. And we took the full settlement back to the Supreme Court. So this is a completely endorsed, and we asked a couple of questions. Is it good for Pakistan? Is it good for Balochistan? Or we didn't ask them, actually the president of the country asked the Supreme Court, because he's authorized to do this. is there any risk that the agreements that we've got now can be challenged by the Supreme Court going forward, et cetera, et cetera. And there's a series of questions. And a five-judge bench of the Supreme Court sat for 30 days and reviewed any challenges over that period of time. And so we're comfortable that that endorsement of where we're going is as solid as you can get, as both with the governments, the different governments, the political spectrum, and also under law, under Pakistan law. And now, and Pakistan is a complicated situation. You have the establishment, which is the military, and then you have the government, and then you have the civil service. And the civil service is very efficient. And so we then sat down and talked about how we were going to do this. And our agreements laid out as Simon explained, laid out the whole process of how we're going to permit, or sorry, it was Tim, how we were going to permit this project. And we've been working on that. So Tim, I talked to the senior members of government and the establishment every time there's a wrinkle. So we have an open communication at my level, we've got an open communication at Mark's level, and Tim and his team are constantly engaged on the ground and back into the oversight. And that means Ministry of Petroleum and all the other ministers. And the Prime Minister's office has set a touch point that we can work through. And the commitment is, and it was a public commitment, we're going to change the red tape for a red carpet for investors. And this is the big challenge for all of us. And it's such a big project. The team has done so well in actually touching the community even. We've got our CDCs, which you know about. That's community development committees. We talk all the time. We've established schools, infrastructure, invested, and we agreed under the settlement that we would advance monies based on while we were preparing the feasibility, and then once we started investing, we would take a portion of our investment and put it back in the community. And this is what I've learned in my career. So we bring some of, the mining industry always insisted they got all their capital back before anyone benefited. And that's backfired in many places around the world. And what we've done is we put money into the communities and the country ahead of getting all the capital back, and we start sharing dividends, distributions on a slightly lower ratio, but that everyone starts winning. Otherwise, you have one big blob of money coming at the end of the mine or way into the life of the mine. And so right now we do not suffer from roadblocks. We certainly manage challenges every day, but we've got a series of elevated engagements at different levels of government that we escalate very quickly. And when you see where we've got to already on all the critical permits, we've just finished and submitted the environmental impact assessment, for instance. And so we have a timeline to get all the permitting in place. We have no issues with that. I'm not sure that I'm answering your question. Am I?
Yes, you have, Mark.
Okay. Yeah. Thank you.
Hi, guys. Just quick on the one of your slides, Graham. You have your upstream taxes and PV streaming declining pretty substantially over the next couple of years. What is that about?
So, Chris, it's really a function of where we've come from rather than the future. So the elevated portion of that in the past relates to some of the specifically higher taxes that we paid, specifically in the US. So we had some educational taxes and some extra taxes that we paid historically. So it's really about the inflated past rather than the reducing future.
Do you expect your cash tax rate to decline then over the next couple of years, the percentage tax rate?
You know, we currently have an effective tax rate of somewhere around 30%,
right,
depending on what gold price you use. Obviously, the higher gold price you have, the more profitability you have, the less the impact of those parts of our business where we don't have a tax shield and a tax benefit. So we tend to have a lower effective tax rate in a higher profitable environment. But somewhere around that 28 to 30% effective tax rate is what we expect to see going forward.
Okay, great. And just a quick question also on the Nevada gold mines. Does the 10-year outlook include 4 Mile and the extension of the chug in that Hansen and that kind of stuff, or not?
There's a very small contribution at the end of the 10-year outlook from development or coming out of 4 Mile, but there's no primary production or at all. So essentially, no.
Okay.
The Chug Hansen extension hasn't been incorporated at all into that outlook yet, and that's one of the things we're working on upcoming this year.
Okay, so the Chug as it stands now goes for 10 years. The Chug reserve goes 10 years.
Yeah.
Okay.
And I think it's important, when you take the size of 4 Mile, the relative capital to develop 4 Mile is very low because it's really 2 access drives, twin declines into the main part of the ore body. The rest of the infrastructure for a mine that size, if you had to build it anywhere else, because it's right in the middle of the Carlin infrastructure, so it's significant, and when you just, the slide that Simon showed, Gold Rush is still ramping up. And what he did is just took the Gold Rush numbers and changed the grade. And there's a whole lot of other benefits because the rock is much more competent because it's silicified, and the ore bodies are breccias, so they're much bigger. So your mining methodology will be different to that in Gold Rush. So it's a very significant benefit. And I would also add that we've got the 14 million ounces in Leeville, but the greater Leeville is still work in progress, and that isn't in those plans. And so we've got to do what we're doing in 4 Mile. We've got to design some additional infrastructure because this greater Leeville has multiple ore bodies that we are going to be investing and evaluating going forward. So, you don't, if you look at the Barrick portfolio, we've got this sort of opportunity through all the big deposits. And we're now on top of Nevada, really on top of Nevada. The big drive is the cost, that extra sustaining cost, which is an extra capital cost, that we need to take out, and we've got a focus to do that, and hopefully we shared that with you today, that we know what it is. It's not some magic that we're going to, sort of remove by not doing anything. We're going to finish investing, and then it goes back to its normal sustaining costs. And so, the upside of, we still haven't found that next 4 Mile, but we're going to, because if you just think 4 Mile took 30 years, it was 1 mile away from the main Cortez ore bodies. So there's a lot of opportunity as we unpack the geology across all 3 trends that we're working at the moment.
Okay. I just have a quick question for Grant. In terms of how what are the methods by which you do reduce the closure liability? So you said something about P Arena, like Can you give an example of how that happens? Because it is a lot of money.
Yeah, I mean, I think a lot of what we've looked at is how we take away these the big liabilities from these, and more often than not, it's long-term water treatment. So many of the closure plans that we inherited were reliant on treating water in perpetuity, and where we come from, that's not closing an operation, because you still have to have people there that have to maintain that water treatment. You need to make sure it meets those criteria. And what we've looked at in Purina in particular is just alternative ways that we can treat that water, quicker ways of doing it, and also benefiting the community. And that's what we've achieved actually through that. And same goes for many of our North American legacy sites. We've focused in on the water treatment aspects, looking at passive water treatment. You heard Christine mention golden sunlight, where we're removing the source of that potential contamination in a tailings facility, which you'll know from the Randgold days. We pioneered. We've done that before, and it's providing a benefit to Nevada. So those are some of the ways that we're doing it. There's a lot of research and development that we're doing with the team too, not only in water treatment, but revegetation that we're doing. And I think that's unlocking that value I was talking about earlier, and I think why we've got that $1 billion reduction since 2019 in our liabilities.
Yeah, just following up on 4 Mile, given the potential huge scale, it just seems it would be very challenging to fold that into the JV at its full scale. So are there strategies to potentially mitigate that, folding it in tranches or something just to make that process easier? Thank you.
Yeah, and there's a process to go through. So the joint venture agreement provides effectively an automatic put and call, both sides. But as you can see, if you look at the optimal way to do it for Nevada Gold Mines, it's to roll it in over time. And it's also less costly to do it that way. I'll just give you an example. There's a potential $500 million saving if we put those declines in early and we drill the ore bodies out from underground and not from surface. So there's a motivation already, a substantial saving. So there's a process here. The key is to finish this work that we're doing, where we're nearly done, and then to embark on a pre-feasibility program. And we'll have, by the time we finish this program at the end of the year, we'll have the critical thing is geotech. So we'll know what those declines are and what rocks we're going to be developing through. And the other shoe to drop is metallurgical test work. Because what we're seeing is less carbon in some parts of the ore bodies. And so if we know that some of it is single refractory, which means it's autoclave process feed. And we've got lots of autoclave capacity. Our critical bottleneck is roaster feed.
If you play that video back on our website, you'll see generally that sub-horizontal material is more the double refractory material that I said, and that vertically continuous silicified material. That's what we expect to be primarily single refractory from results so far. And again, that subvertical mineralization, that's the much more competent rock unit, which will support potentially quite bigger mining scales than ever done before in Nevada, but more equivalent to that we do elsewhere in the world in Africa.
Thanks. And then just a bigger picture question around your forecasting process, I guess maybe for Graham or for Mark. If we go back to this event 2 years ago, the forecast for 2024 was something like 4.5 million ounces, right? And, we haven't achieved that. Mining's a hard business, stuff happens, assets were underinvested. But as we look at the forecast that you've presented today, are you comfortable that all those risks are now reflected? Because I think, gold investors, unfortunately, have been conditioned that, forecasts from large North American gold miners aren't necessarily to be relied upon, right? And that's part of the challenge of what we've seen with the stock prices. Thank you.
Yeah, I think I've been in this industry a long time, and we go from instant gratification to appreciation of long-term capital, and we're in that short-term trading phase. But if you look at the Barrick shareholders, a lot of them are long-term owners who understand this. And the two drivers in the change in the guidance, which by the way we guided with our MD&A at the previous quarter and gave the market, and we had already guided the two challenges, and that is that there's a slower ramp up in PV, but that doesn't take away from the value of PV, and we're still still got lots of upside just in the gold price. In the gold quarry, the other impact is gold quarry and the redesign of gold quarry. And this is so we are at the stage in Nevada where we understand our ore bodies. But you travel that road with us. When we started in 2019, and we were very clear to the market, we had no cover on anything. So, we relied, and we had no geologists, by the way. And we now have full MRM. We had no mineral resource management structures or anything like that. And we started on hand to mouth from both, Newmont's assets some of them were 18 months behind on plans. So, and Barrick was high grading and really not, wanted to take all the money. So very little forward investment. Today we've got, real cover on all the ore bodies. The last two that really we had to work on was Crossroads, which you saw that impact of Crossroads as we forecast and then got it wrong because it was a different mix of ore and we had to re-drill it. But once we got the drills in there and we covered the ore body, then we were able to plan it properly. And it's a key component of the pickup in Cortez, and Gold Quarry has had a history of slips, and this is the first wall failure which we called and monitored. So it's the first time it's been properly monitored and called, and we're still drilling out that ore body. And we've got another challenge in that on the backside, phase 6, we've still got some issues with water that we need to evaluate and see if we can dewater. And so given those situations, and we've done a replan that we know we can deliver against, and we've got work to do to optimize it. And once we have it optimized, we'll come back with an update. But as we stand at the moment, I think what you should take away from this series of presentations is we live this game all the time. And, and I've never been a person who sandbags a forecast. So we've been through some challenges. Some are homemade, particularly on PV. We're on top of that now. But the ones that weren't homemade is inflation in the US, because we are a US producer. And COVID hurt every US business because of the impact on people. And we've got through that very well. And today, when you look at the quality of our leadership, the quality of our labor force, it's a whole lot better than it was before COVID. And so we will create more and more agility to be able to deal with these things. And I would much rather have a company where everyone in the company understands what returns is and focuses on creating value, rather than spending an inordinate amount of time sandbagging the plans. And I would just point out that we're on track to get within guidance. So, and in my career, these last 2 years have been difficult years to manage that. But over my whole career, I've pretty much met annual guidance, but very seldom met quarterly guidance, on both sides. And that's what we do, is we give you a budget plan and we shoot to meet it. So, and ultimately, at the end of the day, there's a huge amount of value embedded in Barrick. And what we want you to do is hold us accountable of unlocking that value, rather than, seeing if we produce the gold, because gold is really, it's about value. How are we going to create that value? And I'm very comfortable we will. And by the way, probably some people know, but as a member of our executive team, we are all owners, and I own a substantial amount, more than most of your funds own in the company, and Graham does, and every executive here has a requirement on a multiple of their gross salaries to own shares in the company. So we are absolutely aligned with our shareholders as an organization.
Just one more question on the Reko Diq, to follow on the question that Dan was asking. Just one is just in terms of the equity contribution of the partners. So those are the SOEs, those are the Pakistani SOEs, and they're fully on board with their percentage, with their portion of the equity. So that's all good. I mean,
affirmative, yeah. So they carry their share of the capital,
okay,
in the same way that we do. And as Mark touched on earlier, these are some of the largest, if not the largest, businesses in Pakistan. They are petrochemical-based businesses, so they're generating dollar-based revenues. So, our choice to partner with them was a deliberate strategy in terms of aligning ourselves with the strongest corporate entities, as well as the fact that they have very real experience of operating in Pakistan, in Balochistan. So they're very useful, valuable, capable partners. It's probably also worth mentioning that a large portion of the spend on the project is actually going to be in Pakistani rupees, along with our strategy of trying to maximize local procurement, local spending. We will be using a lot of local partners. So to the extent that there is local spending, it's very easy for our Pakistani partners to fund that because they are local. And our funding naturally would come from